More today to talk about, but let's get to Infosys very quickly. They've reported their first quarter results in line with street expectations, underscoring stability in their core IT business, services business. New deal wins have fueled optimism as FY26 revenue growth guidance was revised to 1 to 3%. Puneet joining with all the details.
Well, thank you for that. So it's definitely a very strong number for Infosys. It's the only company in the large cap IT space to report positive constant currency revenue growth in this particular quarter. The numbers also, both revenue as well as EBIT, were higher than street estimates. And while the profits did fall in this particular quarter, and that was lower than what the estimates were baking in. So roughly around 6,900 crores of profits versus estimates of 6,700 crores. The two key things, very positive. One, deal wins, $3.8 billion. The last three quarters have been largely between $2 to $2.5 billion in terms of deal wins. That was the first positive. And second, with a pinch of salt, because the guidance has been revised from 0 to 3 to 1 to 3%. Some brokerages were anticipating it to inch the upper end also to 4%, but that has not played out. But we also had the management yesterday in terms of in the press conference, they spoke about the strategy of acquisitions, something that has benefited the likes of Coforge as well as Persistent, as well as some commentary on the revised guidance that we just spoke about. Listen to what they had to say.
We've seen very strong work that we've done on AI with agents, and we see that. And we also see the economy globally, both in Europe, US, going through changes. So keeping that in mind, we've narrowed the guidance and increased the lower end. On the inorganic part, I'll let Jayesh mention how much of it is inorganic.
Yeah, so inorganic in this quarter has been around 40 basis points. Within our 2.6% that we reported. And for the full year also, it will be similar number.
Okay. Moshe Katri, MD, Equity Research and IT Services and Payment at Wedbush Securities joining in. Moshe, thank you so much for speaking with us this morning. And let's just get your take on Infosys. The numbers actually better than what was expected, but the management commentary, they're being very clear that the worst is not over yet, isn't it?
Good morning. It's definitely not over. It's not over just because if you look across the board, the deal pipelines are very strong. The deal wins are very strong. Ultimately, growth is going to be a function of how quickly can you ramp, can you convert these deals. In general, I think there's a sense on the street, and I've been covering this industry for some time, is that there's a huge discrepancy between the fact that you have stock markets globally trading at year highs, but on the flip side of it,
we seem to have lost that line. We'll try and get Moshe back in just a second, but we seem to have lost that line on it. Just the point. Okay, there we have. Moshe, can you hear me?
Yes, I can hear you.
Okay, we've sort of lost that line in the middle, but please continue.
Yeah, what I was saying is that you have the discrepancy between, the global markets that are trading at record levels versus the fact that enterprises simply are not spending on discretionary work. And clearly that's impacting visibility for the sector as a whole. So, typically the June quarter is strong, the September quarter is strong. We're not seeing that in the numbers, and it just feels that the second half is going to be a wash for the industry.
Moshe, speaking specifically about Infosys, though, it stands out among its peers, doesn't it? Because it's managed to beat the street, at least the consensus estimates for revenues on the top line. The deal wins seem to be okay, though it's being a little cautious. In the past, they have under-promised and over-delivered. Do you think that this is another situation like that? And I completely take the point that companies are not spending on discretionary. But could it be that Infosys could be a standout, and why could that be?
I think they're a standout because their deals are ramping probably a bit better than expected. So you're seeing all that kind of reflected in better than expected top line growth, better margins. They've done a really good job on managing their cost base for a couple of years now. So I'm not surprised. But again, remember, we're not really even, within in the context of what we've seen in terms of growth rates for the industry, 1 to 3% is not what you would expect to see in a market like that. So it's really unusual to see these growth rates just because of this macro uncertainty that continues to prevail and continues to impact visibility across the board for companies in the space. And you have some growthy areas in the space, product development, ER&D, Gen AI enabled digital IT services. This is where you're seeing growth, but discretionary is really not recuperating and not recovering. And I think that's impacting everybody who's in the space.
Moshe, just I know we would have largely spoken about or wanting to speak to you about Infosys, but I'm just trying to think, what do you make of Infi versus the rest of the IT pack, part one? And we were just talking about it in the morning, that we're talking about how large caps are growing 2, 3, 4%. And here are mid caps and small size companies or non-nifty companies talking about anywhere between 12% to 20% revenue growth, even in such an environment. No doubt the valuations are high for them.
Yeah, so the tier one large kind of digital IT services companies, the ones that are based in India, I don't know, roughly half their business is generated from cost takeouts. The other half is generated from discretionary spending. The cost takeout piece is really what's driving growth. So low single digit growth is probably where you're going to see these companies growing. The smaller companies in the space are doing a bit better, but again, they're probably more niche-y. They're focusing on the growthy pockets area of the industry. As I said, the product development side, the ER&D part, the Gen AI enabled IT services. This is where you're seeing that growth. Discretionary is just not growing. And the large IT services names have that large exposure to discretionary spending. And that's impacting overall top line growth.
Okay. Moshe, then the final takeaway on the space, and I will state that we've completely accepted that there is so much uncertainty. But in that context, for investors to take a call either on stocks that they currently hold in their portfolio, or if they are looking to deploy and buy in this period of uncertainty to benefit down the line, how should they make that decision? What stands out to you as a relatively clear winner in the space, maybe both large cap as well as mid cap?
I think you need to, in order for you to own the space, you have to believe that you will see some sort of a demand recovery. I don't know, early next year, during the first half of next year. That's number one. Number two, you do want to focus on some of those companies that have a really good mix of cost takeout and discretionary work in their revenue base. The tier ones look great, especially now that it seems that expectations have been reset. But do you want to buy early, or do you want to wait a bit until you get better visibility? And that's the main question here. So it's a tough call right now. And on top of that, you continue to worry about the impact of Gen AI on the business, the impact of GCCs on the business. There is definitely a lot of uncertainty in the space. What's really ironic is that you're seeing some of the takeouts in the space, whether it's ThoughtWorks, WNS that will be taken out by Capgemini. The takeout multiples are much higher than the publicly traded multiples. There's a 20-30% PE multiple kind of discount for the publics. And that kind of tells you that, there is value in these companies right now.
All right. Thank you so much, Moshe, for joining in today. Infosys, good set of numbers, but the pain continues and persists. Maybe your mid-cap or smaller companies relatively are those that are more nimble.